Alright guys, welcome back to the channel, and today we're talking about the COPX ETF. Now, I also want to talk about in this video how you can use this ETF to make income. So you're not only going to be benefiting from the price of copper potentially and the movements in the copper market, but you're also going to be getting a cash flow from this investment. Now, this ETF does pay a small dividend. If you look at the dividend yield, the trailing 12-month dividend, 55 cents. So not much, only 1.17%. Copper is a commodity. Copper is a commodity that has tremendous potential. There's a lot of people who are very bullish on copper due to the increased demand. And so the idea is, depending on how much supply there is to meet that demand, that the price could do very, very well in the coming years. I am one of those people. And if we actually look on this ETF's page, the Global X Copper Miners ETF, the actual company website, you can see where it talks about all the metrics here. High growth potential. So it says supply may not keep up with rising demand, and an imbalance could support copper prices and present opportunities for miners. Structural tailwinds. So copper is an essential input in electric vehicles, renewable energy storage, and other forms of next generation infrastructure that we expect to gain popularity. And ETF efficiency. So in a single trade, COPX delivers efficient access to a basket of companies that are involved in the mining of copper. Now, I talked about GDX in the last video. GDX was the VanEck Gold Miners ETF. I also talked about how you can use a similar strategy in that video to benefit from gold and silver miners. If you're interested in that video, check it out. So in this video, though, we're specifically focusing on this ETF because it invests in the companies that are focused on copper mining, which is what we want, right? Because basically what that means is, assuming we're investing in the right companies, which we hope this ETF is doing the right thing there, we want to get that return in excess of the copper price itself if we can. So we want that alpha in terms of, for example, these companies, right? So it shows you the ticker symbol. Some of these trade, or you'll see a lot of these actually trade on different exchanges. Like you can see how it has the different, I think CN, I forget which one that is, maybe Canada. There's a lot of different copper mining companies that are international. So you're getting international diversified exposure to a lot of different copper mining companies. Now you also have the shares held, and it shows you exactly how many shares of these companies. One of them, the most common, is going to be Southern Copper. We know about Southern Copper. Also Freeport-McMoRan. How could we forget this one? So there's a couple of them that are kind of common, but a lot of these other ones are going to be more internationally based companies. Now, if you look at the longer term performance of this ETF, honestly, like this ETF came out in 2010 and is trading at $46.75. If you look at copper prices, though, long term, you can kind of see a similar trend in terms of copper prices going down and then going up after 2020. And now we're starting to see an uptrend in this ETF. So it's taken a long time for this to get back. But right now, I'd say we're kind of in a commodities bull market. And you could argue over the next 10 or 20 years that things could be very favorable for copper. And so in that case, maybe this ETF is worth a shot. But instead of just buying this ETF and hoping to get this massive return, why not utilize the ETF? And really, if you look at the last 6 months, for example, the sideways trading of this ETF to gain a return. And so the return we're talking about in this case would be selling cash secured puts and covered calls. We're going to be, first of all, selling a cash secured put. If you look at this, I have 10 contracts. One thing to keep in mind if you're new to options, and I have plenty of resources you can check out if you're new to the options market below. But one thing you always have to consider is that each options contract, whether you're selling or buying a call option or a put option, those are the two types of options, calls and puts. Calls are for going up in price, and puts are betting that the price will go down if you're buying the option, right? So you can sell an option and buy an option just like you can a stock. It's basically a derivative of the stock or the ETF itself. So what that means is, if you have a call option and you buy 100 shares of stock, I'm sorry, let's rephrase that. So let's say you own 100 shares of stock and you decide to sell a call option. That would be considered a covered call. Conversely, if you put up the collateral to buy a stock or ETF at an agreed upon price, then that would be known as a put option. So in this case, if we're buying 1,000 shares of this ETF, we could enter into what's called a cash secured put trade. You'll see that I have the strike price pulled up here. price of the ETF itself right now in the open market is $46.82. So that means we're going to be selling a $46 strike put option that expires. And this is the other thing, the expiration day. You always have to keep in mind what the expiration day is, because that's when the contract is no longer valid. So essentially what you're doing is entering into a contract. And when you do that for this trade, you're going to receive an upfront premium. Now, the premium is to compensate for the risk that the ETF goes down by the time you have to buy the shares at $46. Because what'll happen is, if this ETF is below $46 upon expiration day, then you will be forced to basically buy 1,000 shares, because we're selling 10 contracts. So 10 contracts times 100, as we mentioned, each options contract is 100 shares. That would equal 1,000 shares. So we're on the hook to buy 1,000 shares of this ETF at $46 per share. Now, if we look at the expiration, November 15th, right now, today is October 11th. And so if November 15th rolls around, a little bit over a month away, and let's say this ETF is trading at $47 on expiration day, and it doesn't go below 46. Let's say it stays above 46 and actually starts uptrending to $50 or more. In that case, this option would expire worthless, and you would collect the premium for selling the option, and nothing would happen. But like I said, if it finishes below $46, you're going to be forced to actually buy the 1,000 shares at 46. Now, if the ETF is trading at 43, tough luck. You still have to buy at 46. That's the agreement you enter into, and that's why you're getting paid to buy this ETF to compensate for that risk. But it's pretty sweet because you can receive that cash up front, and then hopefully, especially if you're wanting to buy a stock or ETF, it won't be that bad because you're planning to buy the stock or ETF anyway, and you can simply get paid for it. That's kind of the way I look at it. Now, if we take a look at the actual premiums we would receive if we did this on 1,000 shares, you can see that the current bid price of the option in the market right now is $1.60. That means we're going to receive $160 for each options contract, because we're multiplying this by 100 to factor in that each options contract is 100 shares. So $1.60 times 100 is going to be $160 per options contract. Now we're selling 10. We're going to simply multiply that by 10, and we're pocketing $1,600 in our pocket. Okay? $1,600. Now, after commissions, you'll see there's a $6.50 commission that Fidelity will charge us for placing this trade. We're going to collect $1,593.50. Now, it's important to remember that this cash is going to be yours right away. You get to keep this, and this is yours no matter what happens. That's the beauty of this strategy. Now, on the flip side, we're taking a put option, sell to open, 1,000 shares. Let's say it finishes below 46 on November 15th. Now we own the 1,000 shares. So what we're going to do is simply turn around and sell a covered call. Now, this is an agreement. Let me go back to where I was. This is an agreement to actually this is an agreement to sell your shares. So once you're long the stock, once you own the 1,000 shares, you're going to enter into this covered call trade. And what's going to happen is you're basically going to say, hey, I will sell my 1,000 shares at this agreed upon strike price up until this day. So it's the exact opposite of that cash secured put trade. And this is what's known as the wheel strategy. And it's a strategy that I've talked about a lot on this channel because I'm very passionate about it. And I believe it can be used actually to help a lot of retirees out there take control of their portfolios and actually potentially retire early because of the cash flows you can be receiving from this, while potentially even reinvesting some of these cash flows for future cash flows, right? And so that's the beauty of it, because you can substantially increase your yield. And if you're doing this correctly, if you're doing this on a diversified basis, I mean, I say do it against different ETFs, do it against different individual stocks, depending on your risk tolerance, but don't just do it against one ETF, right? Or one stock. You have to keep these things in mind. Now, 1,000 shares at this price, you're probably looking at this, $46, and you're thinking, well, Drew, that requires $46,000 of capital. I don't have $46,000. And then my question to you would be, well, how can you get $46,000? I mean, it sounds like a crazy question. Oh yeah, I'm just going to, make $46,000 show up in my bank account. But that's not the idea, right? So if you think about a 5-year plan of how you could go from 0 to 100,000, and you had a plan where you're going to invest a specific dollar amount every month in your Roth IRA, your traditional IRA, even your 401k. If you said to yourself, no matter what happens, I'm going to invest this much per month for 5 years straight, and the maximum right now for IRAs, for example, I think is $7,000 or $7,500 if you're under the age of 50. And then you have a catch-up contribution for IRAs in particular. 401ks are a lot more. You can put like $20,000 or $30,000 a year in there. It's all about your income level and expenses and prioritizing that. So what I'm saying is, 5 years after putting, let's say, $7,000 into a Roth IRA, not accounting for any type of compounding, 5 years later, you have $35,000. So you're almost there. And also keep in mind, there's cheaper ETFs. I've done this against SLV. It's going to be cheaper, and you don't have to do this against 1,000 shares either. You can do this against 100 shares. In that case, you would need less than $5,000 to get started. Now, you're going to receive less money, obviously, when you do it against less contracts because you're not selling so many contracts. But nonetheless, you're still going to get started, and you might be able to do this with only a few $1,000s. So even though I'm doing this with a larger amount to kind of get you to see the possibilities as your portfolio grows, keep in mind that if, when you're sitting at a $500,000 portfolio, you could technically do this against 10 different ETFs and have a very diversified portfolio going for you while collecting these covered calls and cash secured put premiums. And that's the beauty of it. And that's what I love about this, because you can think long term and you can think about how to benefit your portfolio. Now, if we're looking at this from the call option side, as we were talking about, let's go to the same expiration because it's probably best. We do have an expiration on October 18th, which is 1 week away. We could try to use that for a weekly option and roll that into the next monthly, which would only be a few weeks away at that point. But what we're going to do is just go for the monthly option again in this case. So at a call option, assuming this is trading at 46.79, let's say we already own the 1,000 shares because the put option went under 46 before the expiration day, but we're just going to pretend like we're rolling this over, and now it's November 15th is the expiration still. This time, since the price is at 46.79, we're going to do a $47 call option. It's about 21 cents, so worst case, we can still make 21 cents. Remember, we bought our shares at 46, collected the premium, and now it's trading back at 46.79. So we're actually in okay shape. 47 minus 46 is still $1 per share. So we can collect $1 per share profit on the 1,000 shares. So that's at least $1,000 from the principal that we invested. And then additionally, what we can do in this scenario is go ahead and sell that covered call, which is very sweet in this case. So $1,943 for this, and that's just due to the fact that this price right here is so close to this price, and there's still over a month to expiration, so people are factoring this in when they're pricing the options. $1.95 on the bid. If you do the math on that, take it times 100, $1.95 times 100 is going to be $1,950, and you have a total premium that you would receive of $1,950 less this $6.50 commission, and you are going to have a $1,943.50 profit, exactly as indicated. Now, with that being said, I want to thank you all for tuning into this video. I hope this kind of gave you some insight on how you can potentially benefit from the price move in commodities while also trying to get some cash flow from your portfolio. And like I said, you may be looking at this and saying, well, I can't do this because I don't have enough money. But find a way to get enough money, even if it's only $5,000 or $10,000. There's different stocks and there's different ETFs that are on the cheaper side that you can do this against, and that's just the key, is to get started. So don't worry about it if you don't have 50 grand laying around. I totally get it. Most people don't. But you have to start somewhere. And so doing this against COPX, the Global X Copper Miners ETF, remember, none of these are recommendations. I'm just using these as examples of what's possible, where you can gain exposure to a wide variety of copper mining companies while getting that cash flow, I think is a pretty sweet deal, especially considering that this ETF, it really hasn't done a whole lot. If we look at over the last even 5 years, it's kind of been a very sideways pattern. It's now just breaking out of that channel. So it could trade sideways some more for a long time, maybe, And that just gives you a better opportunity when you're doing this strategy, because you actually kind of want that neutral price action to get those premiums. It makes it a lot easier when it's trading in kind of a tight range like it was here, between 38 and 40 for a long time there in 2023 before it broke the trend line, right? So that's the idea, guys. Let me know what you think in the comments down below. God bless you guys, and we will see you in the next video. Take care.